Hey dreamers, as you know, I've been trying to add diversification to spread out risk wherever I can right now and into the future. So while I was waiting for my toast, I was getting the knife out. I guess I was wiping the counter. But also, as I was staring at the toaster, I was thinking about UK stocks. I've been on the hunt for which UK stocks that pay solid dividends, are not hugely volatile stocks, and therefore offer some safety, might be on sale or undervalued, and are also candidates for a long-term hold with some potential growth. So today I've got 2 UK stocks to show you that I personally hold. Okay, so here are the 2 UK stocks I'm going to go over today, and the first one is BTI, British American Tobacco. Currently I've got 192 shares at $44. Total current value of $8,493. It's got a beautiful yield at 6.7, which kicks off an income of $569 annually. The second stock to cover today is ticker symbol GSK, or GlaxoSmithKline. I've got 212 shares at $44.26. Total value of $9,397. A yield of 4.86% that kicks off $456. So in total, across these 2 UK stocks, I've got just over 400 shares, just under 18,000 in current value, a really nice 5.73 yield across the 2, and an income of just over $1,000 a year. So let's take a look at some of the important stats down here. So as you know, my goal is to try to get between 2 and 5%. BTI easily beats that with 6.7%. The beta, I like to have under 1.0 if I can, so it's 0.9. We've got 3 years of dividend increases from BTI, 12 consecutive years of dividend payout, a 58% payout ratio, which is fantastic, and a nice 5-year CAGR of 6.3. GSK has that 4.86 yield, 0.7 beta, which is great. Only 1 year of dividend increase, which is really not good. Again, what I try to do is get at least 10 plus years, but they do have 13 years of consecutive payouts. Now, this is a red flag, this payout ratio, 86%. You don't want to see that. I like to get between 40 and 60%. That's really the ideal range. 86% means, that starts to raise questions in my mind. Are they going to be able to continue to pay the dividend? That's something I would want to dig into further. Also, a 1% 5-year CAGR, also not the greatest number here. So another thing that I'm going to dig into. So whenever you see numbers that you don't particularly like, that's where you want to do a little bit of research and say, okay, that's historically what's happened. What do I expect to happen in the next 5 to 10 years? Now, you may be thinking, why don't I have BP on my list? Well, in terms of BP, yes, I have considered and looked into it. Everyone has to make decisions on what's right for them. In general, I am lighter on the energy and oil sector and lean towards those with a strong renewable focus. But for me, I have a few thoughts that prevent me from buying that juicy dividend. One is that it's subject to more volatility based on the economy. 2 is that oil and pipeline companies, they have incentives against conservation, and that always worries me. 3 is that I think oil will peak in the 2020s, just like whale oil did in the 1840s. And that's just my humble opinion. But it may be a good play for others, especially in the short term. Now, BP does have several renewable projects happening, so, perhaps as they start to grow in this area, maybe it would become a new target for me. So now let's talk about BTI, British American Tobacco. And here's where I purchased my tranche of stocks. It was around July of 2021. And so you can kind of see, over time, over the last 10 years, it had kind of this steady increase. And then there was, regulatory scare here around 2018, which dropped the price precipitously. It's been low ever since, but then there's something going on right here very, very recently. And that's what I've been kind of looking at and thinking about and really waiting for. Here's what I see. I see cigarette sales grew for the first time in 2020. Lots of conjecture about why that happened, stress, people working from home with more usage occasion, opportunity. We look at the dividend history here. You can see they used to pay semi-annually, and now they pay quarterly. We see the little bit of an increase going on over time here. And essentially, what I see here is that this is one of the best defensive stocks that is also an income stock out there right now. This is a Seeking Alpha article that goes down the litany of reasons why it's such a great stock to own right now. Very safe, 7%-ish yield. Obviously, that yield is going down quickly because the stock price is increasing so dramatically. And that's happening because investors are really flocking to this stock. They see a nice CAGR, and the consensus here is that there's going to be a 12-month return of 44%, and that is a conservative estimate. So, digging in, you can, look into what the Chief Marketing Officer of British American Tobacco talks about. Essentially, he talks about the new vaping products starting to become profitable in 2025. So we've got the traditional product not decelerating. We've got new products starting to pick up speed. And also, ultimately, I think that the future of big tobacco is cannabis, which is going to be a huge growth play. So, I'm not going to go in depth here on, the entire tobacco industry, but if you're looking for more information on that, I show how much I've invested in it and also my insights into how likely they are to go into the cannabis market. And you can see all of that in my video, 3 of my favorite sin stocks. So with that, let's dig into GlaxoSmithKline. Now, as a reminder, I'm not a financial advisor, and also I'm not a healthcare expert, so I'm just an investor reading the tea leaves. So here's what I see. I see articles like this, 4 reasons why you should add GSK to your portfolio, and then I see it might not be a great idea to buy GSK. And whenever I see articles that flip-flop all over the place, I see opportunity and I see confusion. Whenever there's confusion in the marketplace, it means that there's some level of uncertainty for the business. People are not sure if it's going up, down, or sideways. And typically that means that the stock has been undervalued because, again, the market does not like uncertainty. So let's dig in. So here we see the 1-year consecutive dividend growth and the 13-year consecutive dividend payout. And this is what that looks like. So we can see that it's been relatively flat in terms of the dividend. In addition, the stock price has been kind of relatively flat as well. So let's dig into that payout ratio. So here we see that kind of troubling 86% payout ratio based on the last 12 months of earnings. But then we see, based on this year's estimates, it can go down to potentially 67% payout ratio. And based on next year's estimates, a 62%. So those are numbers that I'm starting to like a little bit better. That is more in my range. Now, I usually don't show you guys this, but this is Morningstar. And so now I'm digging into, what do I see in revenue? Well, I do see revenue going up from 30 billion to 33 to 34. I like to see that. And then we have EBITDA here, which, don't be put off by big terms. EBITDA is just earnings before interest, taxes, depreciation, and amortization. And that's just a fancy way of saying, how much money is left after all of the bills. And so we can see here, going from 7 to 9 to 10. So I like that. And then we look at total assets going up 58 to 79 to 80. And then the liabilities going from 54 up to 61, which is not great, but then back down 59. So, a couple of things that I see that are kind of interesting here. But this is really where I look into what is going on with the business. And here, this article starts to point to that some of the vaccinations that have been in the pipeline and just come out with GSK, like Shingrix, which is a vaccine for shingles, basically, that essentially the COVID-19 vaccine has disrupted other normal vaccines, other normal trips to the doctor. And that essentially once COVID-19 is over, that those disruptions should be over. So I buy that. That makes a lot of sense. We know that doctor's visits, surgeries, all kinds of things have been put off by COVID-19, and there's essentially this pent-up demand that is expected in 2022, 2023, 24, etc. Now, the other thing that's interesting here is now we can get into some of the reasons why we're seeing what we're seeing in the numbers. So, the Emma Walmsley, I hope I'm saying that right, Emma Walmsley, she is basically saying, listen, we're going to have a huge investor event on February 28th, and that's where we're going to make a ton of announcements. And some of the announcements are just about this demerger. So essentially, they are going to split apart their pharmaceutical business from the consumer business. And in terms of the consumer business, you may know some of their brands like Excedrin and Tums and Sensodyne. So the hope is that it kind of liberates the two sides of the business. And we can see here they're hoping that the new GSK will deliver sales growth of between 5 and 7%. So that would be a good thing if they start to see, approach a period of steady growth they've got, these long-acting HIV drugs with new product launches there. They've got the shingles vaccine, Shingrix. They've got some new things in the pipeline around RSV vaccines that might be approved in 2022, and also a rheumatoid arthritis drug. So looking to extend their moat, and essentially, they don't have any major patent losses until 2028. So they could be entering a really interesting period of growth. So what's going to happen in this demerger, though, for us stockholders? Well, one of the things I found this article, which was kind of interesting. It goes into the details of the demerger, and essentially the hope is that we get some value out of this demerger. And so the expectation is that we will retain our stock shares in the parent pharmaceutical business, aka the new GSK, and then we'll also be given new shares in whatever that spinoff is, whatever they call it, this new consumer healthcare company. So hopefully we will get two halves that actually equal more than the whole of what we have today. So that's what I'm hoping for in this demerger. The bad news is that it does look like we will get some level of a dividend cut. So dropping the yield to, we don't know what it is. It's likely going to be announced in that February meeting, which is just coming up in a couple of weeks. But, in this article, he's kind of looking at 3.8, others say around 4%. So we'll see what happens here. But that is something to be aware of, that the dividend will be cut. The hope, though, is that, GSK uses this additional money and the additional, kind of runway to really invest in their R&D and really go full bore with a lot of those new drugs in their pipeline. And that could be a very good thing for both sides of business. And so that's another reason to kind of hang on and go for growth here. So in terms of me, I purchased this around May of 2021. You can see that in the black dot over here. And I'm gonna hold and be along for the ride. I do think that GSK is undervalued right now, and it's one of the largest pharmaceutical companies in the world. They have a huge moat in terms of their patent protected drugs. So I'm excited about it. And my eyes will definitely be on that February 28th major investor event. So that's it for my UK stock review today. I will continue to watch and add to these stocks in my portfolio as I see opportunity. I hope you join me again to see what happens. As always, I encourage you to keep learning, keep implementing, do your own research, as I'm not a financial advisor. Keep in mind these videos are for entertainment and inspiration only. I will see you on the flip side.